A financial planning article recently appeared in the Globe and Mail, and the article was about Rebecca, who wanted to retire and have an income of $50,000 a year after tax. In terms of assets, she had $1.4 million, no debts, and the article assumed that inflation would run at 2.5%, the home would grow at 2.5%, and investments 4%. So let's take a look and test those assumptions. And here we can see Rebecca's income, $50,000 a year after tax, and this staircase represents what her income would be with inflation. So for example, here at age 76, she'd be withdrawing about $70,000 a year out of her portfolio. She also wanted to purchase 2 vehicles through retirement, so we can see one purchased here and one purchased here, both for $25,000 in today's income. Let's take a look. We've got her net worth, and her net worth is relatively flat over time. Her income assets, so these are the RRSPs, the non-registered account and the open account. And for the plan to be successful, we really don't want any green down here. So what we're going to do is we're going to withdraw from the RRSPs and the non-registered accounts, and we'll withdraw from the non-registered account first. And we see here we still have a little bit of green, so we need to then withdraw from the RRSP account. And we can see here we have a little bit of a gap. Now Rebecca still has income coming in. If we look here, we can see she's got about $18,000 a year, and that's CPP and old age security. So it comes back to, how do we fill the gap here? Well, we still have net worth. This is the value of the home, so she could use the value of the home. Some people would suggest that maybe what we could do is withdraw some money from the RSP first and then from the tax-free savings account. So I've done a comparison here. So here we have the two solutions. In this scenario, this is the first solution. We withdrew from the non-registered, then the RSP. In this case, we withdrew about $5,000 a year from the RSP, put it into a tax-free savings account, and then withdrew from the non-registered account or the tax-free savings account. And we can see that the gap is larger here, so we are better off to withdraw from non-registered first and then the RRSPs. Okay, so what's something else that we could do? Well, one of the things I see in retirement planning is people often straight line $50,000 a year through their full retirement. And often that's not the case. So what if at age 81 we decided to drop the income to about $40,000 a year? And we apply that. And now what we'll see is the gap has been filled. Okay. Now let's go and take a look at the estate. And the final estate, what we'll see, is that Rebecca will be leaving $1.1 million to the estate, or if we look at that in today's dollars, about $569,000 will be going to the estate.